This video will provide a walkthrough to the solution for exercise 14-16, which focuses on accounting for income tax losses. Here's the background data for the problem. Solero Inc. was founded in 2025. In the first 7 years of operation, the company reported the following taxable income and losses before the application of any loss carryforwards or carrybacks. The tax rates were all enacted and known in 2025. Also assume that the taxable income for 2030 is known in 2029 and that there are no temporary or permanent differences in any year. Also assume that management believes there will be sufficient taxable income to absorb loss carryforward amounts. A requirement is simply to prepare the journal entries to record the income tax expense for the years 2025 through 2031. So let's start with the year 2025. The company had $120,000 in taxable income. The applicable tax rate for that year was 28%. Therefore, the current tax expense and taxes payable is $33,600. So the company will debit current tax expense and credit tax payable for that amount. Now for the year 2026, the company had taxable income of $135,000. We'll multiply by the 22% tax rate applicable for the year 2026. That results in current tax expense and payable for $29,700. So debit current tax expense and credit tax payable for that amount. Now for the year 2027, where the company experienced its first loss of $310,000. And that loss exceeds the combined previous year's taxable incomes, so the full amount of taxes paid in those previous years can be recovered. So we'll take the $33,600 in taxes paid in 2025, we'll add the $29,700 paid in 2026. That's a total of $63,300 recoverable in the year 2027. So the company will debit income tax receivable and credit current income tax for that amount. So after carrying back a portion of the taxable loss to recover the previous year's taxable profits, there's still an amount that's left over or will carry forward to future years. So if the taxable loss in 2027 was $310,000, we had the $120,000 2025 profit, and the $135,000 2026 profit, that results in $55,000 remaining to be carried forward and applied against future year profits. And if we take that $55,000 2027 loss carry forward and we multiply by the 25% 2028 enacted tax rate, remember, we know what the tax rates are in advance here. That results in a $13,750 2027 deferred tax asset. This is an asset because the loss that's carried forward will provide future deductibility or shield us from future taxes. Therefore, the company will debit a deferred tax asset and credit deferred tax income for $13,750. Now on to the year 2028, where the company had $85,000 in taxable profits. So what we'll do is we'll take the $55,000 loss carry forward from 2027 and offset that against the 2028 taxable income. That results in $30,000 that's actually taxable in 2028. If we take that $30,000 taxable income, multiply by the 25% enacted tax rate for this year, that results in a $7,500 tax expense. So the company will debit current tax expense and credit tax payable for $7,500. Now, the other entry that we have to do in 2028 is to fully reverse the deferred tax asset that was set up in 2027, because we've used all of that loss carry forward up against the 2028 income. So the company will debit deferred tax expense for $13,750 and credit the deferred tax asset for $13,750, and it will wipe out that loss carry forward. Now on to the year 2029. In this year, the company experienced a rather large loss of $372,000, and as a result, it can reclaim all of the previous taxes paid in 2028. So the first thing we'll do is record the recovery of the taxes paid. We'll debit tax receivable and credit the tax income for $7,500 for the taxes paid in 2028. Now, the 2029 loss is so large that we couldn't carry back all of it. So that means there's going to be a remaining amount that's carried forward. So if we take the $372,000 2029 loss, offset that by the $30,000 that we carried back to apply against the 2028 taxable income, that results in a $342,000 loss carry forward that will apply to future years. Now here's where the little twist is. Per the data, we know the 2030 income in 2029. So what we're going to have to do is make sure that when we set up the deferred tax asset for this loss carry forward, that we apply the appropriate tax rates. So the 2030 income that's known in 2029 will be $190,000. And the applicable tax rate in 2030 will be 27%. Therefore, a portion of the deferred tax asset relating to the loss carryforward will be $51,300, which applies to the year 2030, based on $190,000 times 27%. The balance of the loss carryforward is $152,000. That's $342,000 minus $190 to be applied against the 2030 income. From the data, we know that the enacted tax rate in the year 2031 will be 26%, so that means the other portion of the deferred income tax asset that's applicable to the year 2031 will be $39,520. Therefore, the total amount of the deferred tax asset that we'll set up is $90,820, split between two different amounts and two different enacted tax rates. So the company will debit deferred tax asset for $90,820 and credit deferred tax income. So now we jump forward to the year 2030, where the income is $190,000. The first thing we can do then is apply the deferred tax asset that we set up against this. So the company will debit deferred tax expense and credit deferred tax asset for $51,300. That's the amount that was set up previously, specifically for this year. That leaves us with a remaining loss carry forward of $152,000. That's the $342,000 carried forward from 2029, less the $190,000 applied to the 2030 taxable income. And based on the adjustment that we made in this journal entry, the remaining balance in the deferred tax asset account will actually be $39,520. So now we jump ahead to the last year, 2031. The company had $240,000 in taxable income. Therefore, all of the 2030 loss carryforward of $152,000 can be applied, leaving $88,000 to actually be taxed in 2031. So we take that $88,000 2031 taxable income, multiplied by the 26% enacted tax rate for this year. That results in $22,880 in current tax expense. The journal entry to record the current tax expense will include a debit to current tax expense and a credit to tax payable for $22,880. At the same time, now we can use up the rest of the loss carry forward, which was the remaining balance of $39,520. So the company will debit deferred tax expense and credit the deferred tax asset for $39,520. You could have actually done this entry first to use up the loss carry forward and then determine the amount of tax paid on the remaining amount. Either approach is fine. And that's it. We're done with this problem.